Did you know that reducing or even eliminating property taxes could pave the way for more affordable multifamily housing? It's a fascinating concept that has been gaining traction, especially in the United States. Welcome to the Multifamily Real Estate Insights Podcast. I'm your host, Sandy MacKay. Let's get right to it. In a recent article by Roger Valdez for Forbes, the idea of property tax reductions as an incentive for developing affordable multifamily housing was explored. Valdez highlighted that when housing costs increase, so do prices and rents. By reducing or eliminating property taxes, we can potentially lower these costs, making housing more affordable. The article points out that property tax is a significant factor in the cost of producing and operating housing. As property values increase due to development, so do taxes and operating costs, which can deter improvements. Tax abatement and exemption programs are designed to counter this effect by providing incentives for development, particularly in affordable housing. Several states in the United States, including Alabama, Arizona, and California, have implemented programs that offer tax abatements for nonprofits providing affordable housing. For example, Arizona grants property tax exemptions for nonprofits with housing under a restrictive covenant, which is typical for low-income housing tax credit projects. The article also discusses programs aimed at mixed-income or workforce housing. A notable example is Seattle's Multifamily Tax Exemption Program, which has been successful in producing thousands of affordable units over the years. This program provides tax exemptions on property improvements, contingent upon a certain percentage of the units being designated as affordable. Moreover, some jurisdictions offer tax abatements for projects that rehabilitate older buildings, even if they do not have specific affordability requirements. These programs, found in places like Georgia and Philadelphia, contribute to preserving and enhancing the housing supply, indirectly supporting affordability. Finally, transit-oriented property tax reductions are becoming more prevalent, particularly in areas near light rail stations. Oregon's multiple unit housing property tax exemption program offers such exemptions, encouraging development near transit while including some level of affordability. Overall, these property tax abatement programs recognize the value increases created by new development and seek to mitigate the tax consequences that could otherwise discourage improvements. The aim is to balance the loss of tax revenue with the benefits of more affordable housing and potentially increased future tax income. The Canada Mortgage and Housing Corporation recently released details about their improvement mortgage loan insurance product, aimed at providing greater financing choices for new construction and home improvements. This is a really exciting development for those looking to invest in or upgrade their real estate properties, particularly in the multifamily sector. The CMHC Improvement Mortgage Loan Insurance product offers insured financing up to 95% of the as-improved value for 1 or 2 unit owner-occupied properties, and up to 90% for 3 or 4 unit properties. This means that investors and homeowners can finance their property purchases or improvements with lower down payments, making it more accessible to a wider audience. One of the key features of this product is its flexible financing options for both small and large-scale improvements and new construction. For example, if the improvement costs are less than or equal to 10% of the as-improved value, single advances can be used. For costs greater than 10%, progress advances are available, with CMHC validating up to 4 consecutive advances at no cost. This flexibility is a huge advantage when planning improvements or new builds, as it allows for tailored financial solutions. Another important aspect of the CMHC Improvement Mortgage Loan Insurance is the eligibility for new construction financing. The financing must be approved by CMHC before or at an early stage of construction, and the lender must maintain control of the entire building process. This ensures that the project is completed efficiently and meets all necessary standards, which is crucial for maintaining property value and compliance. In terms of loan-to-value ratios, the product offers generous terms. For homeowner loans, the ratios are up to 95% for 1 to 2 unit properties and up to 90% for 3 to 4 unit properties. For small rental loans, the loan-to-value ratio can be up to 80%. These ratios are designed to make financing more attainable for investors and homeowners alike, encouraging further development and improvement in the housing market. It's also worth noting that CMHC requires a new home warranty for all new homes, ensuring that properties are protected against potential defects. This requirement is in place even if it's not mandated by provincial or territorial law, providing an additional layer of security for investors and homeowners. Overall, the CMHC Improvement Mortgage Loan Insurance product represents a significant step forward in supporting the growth and enhancement of the housing market in Canada. By offering more flexible and accessible financing options, it empowers investors and homeowners to pursue new opportunities in the real estate sector. It's an exciting time for multifamily real estate, and these developments could lead to more vibrant and affordable housing options across the country. Now let's delve into some exciting news from the Canadian real estate investment scene. BentallGreenOak, also known as BGO, has been making significant strides with their new $247 million Canadian Value Add Limited Partnership Fund. This marks their first value-add real estate strategy within Canada, and it's designed to meet the growing demand for higher return strategies among investors. According to an article by Steve McLean on Real Estate News Exchange, BGO has already made 4 acquisitions under this fund. These include a mix of private and institutional vendors, with 3 of these acquisitions being off-market deals. The fund focuses primarily on the industrial and multifamily sectors, particularly in Greater Toronto, Greater Vancouver, and Greater Montreal. This is a strategic move, given the current market conditions and the demand for multifamily housing in these areas. Chetan Baweja, the managing director and head of the Canadian Value Add platform at BGO, mentioned that they see a growing pipeline of value add opportunities, especially given the volatility in the commercial real estate market. This volatility is primarily driven by the ripple effects of the pandemic and the rapid rise in interest rates. Baweja emphasized that BGO's vertically integrated Canadian platform is well positioned to execute this strategy effectively. The fund raised its capital from 9 Canadian institutional investors, including financial institutions, insurance companies, and corporate and university pension plans. Despite the challenging fundraising environment, BGO's strong track record of successful asset repositionings and developments in Canada has helped secure these investments. It's a testament to their reputation and capability in the market. One of the exciting aspects of BGO's strategy is their focus on data-driven investment activities. They work closely with their in-house research teams to identify locations and assets that offer the greatest opportunities for strong income growth and potential for exit within a 3 to 5 year time horizon. This methodical approach ensures that they are well equipped to make informed and strategic investment decisions. Among BGO's first acquisitions is a land site in Coquitlam, which is set to develop 197 rental homes through a joint venture with Anthem. This development will feature 2 6-story wood frame purpose-built rental buildings, addressing the much-needed rental housing in the area. It's a perfect example of how BGO is leveraging their expertise and partnerships to create value and meet housing demands. Looking ahead, BGO is currently assessing a pipeline of approximately $1.4 billion in investment potential. This pipeline is heavily weighted towards multifamily development, which is seen as a huge opportunity to deliver much-needed missing middle housing. BGO is also exploring industrial, retail, office, and conversion opportunities, focusing on the middle market where there's less institutional competition and more off-market deal volume. It's clear that BGO is strategically positioning itself to capitalize on the current market dynamics. Their focus on multifamily and industrial sectors, combined with their data-driven approach and strong network of relationships, provides them with a competitive edge in the Canadian real estate market. It's an exciting time for investors, and we can expect to see more innovative developments and strategic acquisitions from BGO in the near future. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.